Imagine you're a finance minister in Beijing. It is March of 2022, and you're watching Western powers sever Russia, the world's 11th largest economy, from the global financial system with a single keystroke. $630 billion in reserves frozen overnight. The SWIFT network connecting 11,000 institutions across 200 countries suddenly weaponized. Markets applaud. Experts reassure you that sanctions work because there is no alternative to the dollar system. 88% of all international transactions flow through dollars. 58% of the world's central bank reserves are held in dollars. The conventional wisdom is absolute. Dollar dominance is permanent, inevitable, unshakable. But you're not watching cable news. You're studying the numbers, and the numbers tell a very different story. In the year 2000, 912 entities were under US sanctions. By 2024, 12,800. That is not enforcement. That is a pattern. 29% of global economic output now lives under some form of American financial restriction. Every sanction taught the same lesson. If you hold dollars, trade in dollars, or clear through New York, Washington can erase your wealth with a phone call. So you start building the exits. The question is not whether the dollar will fall. The question is, did America accidentally create its own replacement? Let's rewind to the moment it happened. March 2022, the financial nuclear option deployed. Russia, a nation of 146 million people, an economy worth $2.2 trillion, the 11th largest on the planet, simply erased from the global financial system. Not with bombs, not with blockades, with code. Western powers severed Russia from SWIFT, the financial messaging system that connects 11,000 institutions across more than 200 countries, processing 42 million messages every single day. This was not a surgical strike. This was amputation. $630 billion in Russian foreign reserves frozen instantaneously. Assets that took decades to accumulate vanished with administrative keystrokes. Markets celebrated. Cable news analysts nodded approvingly. The message was clear. Cross Washington, lose access to your own money. The conventional wisdom seemed unshakable. This is how power works in the modern age. The dollar is not just a currency. It is the operating system of global commerce. 58% of all central bank reserves held in dollars. 88% of international transactions denominated in dollars. The architecture built at Bretton Woods in 1944, refined over 8 decades, appeared permanent. SWIFT held monopoly status not through military force but through network effects. Everyone used it because everyone used it. The sanctions playbook had been tested before. Iran in 2012, cut, often crippled. Venezuela in 2019, isolated and collapsing. Now Russia. The expert consensus was unanimous. Sanctions work because there is no alternative to the dollar system. You either participate in our financial architecture or you disappear. But in Beijing, in Moscow, in Riyadh, in New Delhi, finance ministers were not watching CNN. They were studying Treasury OFAC statistics. The Office of Foreign Assets Control, the agency that administers American sanctions, maintains public records, and those records revealed something the cable news experts never mentioned. In the year 2000, 912 entities globally were under US sanctions. By 2014, after Crimea, that number jumped to 3,200. By 2021, 9,421. By 2024, 12,800 active designations. This was not enforcement. This was acceleration. The math was simple and terrifying. If you hold dollars, trade in dollars, or clear transactions through New York, Washington can erase your wealth with a phone call. And they were doing it with increasing frequency and decreasing restraint. The pattern became impossible to ignore. 2014, Russia, sanctioned for Crimea, begins building SPFS, its own payment system. 2018, Chinese entities sanctioned, China accelerates CIPS, its alternative to SWIFT. 2019, US threatens India with sanctions for buying Russian weapons. India initiates rupee-ruble trade. 2022, total Russian freeze. 40-plus countries announced de-dollarization programs within months. One data point crystallized everything. In the year 2000, sanctioned countries represented 3% of global GDP. By 2024, 29% of global economic output lived under some form of US financial restriction. The United States had not just weaponized the dollar, it had created an entire global coalition united by a single fear: we're next. Every sanction was a lesson, every freeze was a warning, and the world's finance ministers were excellent students. Dollar dependence, they realized, was not privilege, it was strategic vulnerability, and they started building the exits. While Western media celebrated sanction success, a parallel financial system was rising in the shadows. The numbers do not lie. China's cross-border interbank payment system, CIPS, launched in 2015 with 19 participating banks. A curiosity, a hedge, nothing that threatened SWIFT's dominance. By 2020, 1,092 financial institutions in 103 countries had joined. By 2023, 1,402 participants, processing $1.9 trillion annually. Growth rate, 43% year over year. Then came the Russia sanctions. CIPS usage surged 21% immediately. This was not gradual adoption. This was panic. Diversification. Russia had built its own system, SPFS, the System for Transfer of Financial Messages, after the 2014 Crimea sanctions when Washington first threatened SWIFT removal. By 2022, 480 Russian institutions were connected, plus 159 foreign entities from 20 countries. Current capacity, 2 million messages daily. Then the critical integration happened. CIPS linked with SPFS. China and Russia, representing 3 billion people and $20 trillion in combined GDP, could now transact entirely outside the SWIFT network. The bypass was operational, but the real acceleration came from something most people have never heard of: central bank digital currencies. This is not cryptocurrency. This is government-issued digital money, designed for instant settlement, programmable transactions, and direct central bank clearing without any commercial bank intermediation. China's ECNY launched at scale with 260 million users by October 2023, processing $250 billion in transactions. Russia piloted its digital ruble in April 2023 with explicit sanctions-proof architecture. India's CBDC reached 1 million users by November 2023. The combined potential, 3.1 billion people in alternative payment systems by 2025. The conventional narrative insisted these systems were inferior, incompatible, insufficient. The data says otherwise. In September 2023, the Bank for International Settlements, the central bank for central banks, conducted live tests of Project Mbridge, a cross-border CBDC platform. Participants included China, the United Arab Emirates, Thailand, Hong Kong. Saudi Arabia joined in 2023. They processed $22 million in real transactions. Settlement time, seconds, not the 3 to 5 days required for SWIFT correspondent banking. Cost, 96% cheaper than traditional methods. This was not theoretical. This was operational infrastructure for dollar bypass. The technological gap everyone assumed existed simply did not exist. The alternatives were not just viable, they were superior, faster, cheaper, and critically immune to Western sanctions. Every finance minister watching the Russia freeze understood immediately. The infrastructure for escaping dollar dependence was not some distant future project. It was live, tested, and waiting. The exits were built. Now came the question: who would be brave enough or desperate enough to use them first? The answer came from the one place that could move markets with a single decision: the Kingdom of Saudi Arabia. For 50 years, the petrodollar system was the foundation of American financial power. In 1974, Saudi Arabia agreed to price oil exclusively in dollars in exchange for US security guarantees. This was not just a trade deal. This was the architecture of global dollar demand. Every country needed oil. Therefore, every country needed dollars. Oil exporters accumulated dollars. Those dollars flowed back into US Treasury bonds, financing American deficits. The cycle was self-reinforcing and seemingly permanent. Global oil trade moves $2.5 trillion annually, all of it, for half a century, denominated in dollars. Then came December 2022. Xi Jinping visited Riyadh and proposed something unthinkable: yuan-denominated oil sales. March 2023, Saudi Arabia joined the Shanghai Cooperation Organization as a dialogue partner. These were signals. June 2023, Saudi Aramco announced its first yuan-settled oil transaction. 730,000 barrels sold to China, paid in yuan, not dollars. The volume matters. China imports 1.8 million barrels per day from Saudi Arabia. That is $48 billion annually. Current estimates suggest 20% of Saudi-China oil trade now settles in yuan. That is $9.6 billion in annual trade that used to require dollars and no longer does. The arithmetic changes everything. If 30% of global oil trade shifts to non-dollar currencies by 2027, that is $750 billion in reduced dollar demand. Oil exporters currently recycle roughly $500 billion per year into US Treasuries. Lost demand equals lost financing capacity for American deficits. This is not abstract. This is the machinery of dollar hegemony breaking down in real time. Russia and India created their own bypass. Before 2022, India bought 2% of its oil from Russia. Post-sanctions, 40% of Indian oil imports come from Russia. 1.6 million barrels per day, $50 billion annually. Payment mechanism: rupee-ruble bilateral settlement with UAE dirham intermediation when needed. No dollars involved. Western sanctions were supposed to cripple Russian oil revenue. The actual numbers: Russia earned $180 billion from oil in 2023 versus $190 billion in 2021, a 5% decline despite maximum pressure. The sanctions isolated Russia from the Western financial system. But 85% of the world's population does not live in that system, and they still need Russian oil, gas, and fertilizer. Then came January 2024. BRICS expanded. The original 5 members, Brazil, Russia, India, China, South Africa, added 6 more: Saudi Arabia, United Arab Emirates, Egypt, Ethiopia, Iran, Argentina. The new coalition represents 46% of global population and 36% of global GDP. More critically, 42% of global oil production and 50% of rare earth elements. The stated goal at the 2023 BRICS Summit: de-dollarize intra-BRICS trade. Current volume: $260 billion. Annually. Target: 50% in non-dollar currencies by 2027. The weapon reversed. Before sanctions, the United States used financial access to control commodity producers. After sanctions, commodity producers use resources to escape the dollar system. Russia now accepts rupees, yuan, and dirhams for fertilizer exports. Russia controls 23% of global ammonia, 14% of potash, 10% of phosphate. India paid $3.5 billion for Russian fertilizer in 2023. 90% settled in non-dollar currencies. The world still spins. Trade still flows. The dollar is simply no longer necessary. The dollar's dirty secret has always been debt. US government debt stands at $34 trillion as of December 2024. The annual deficit runs $1.7 trillion. Annual interest payments hit $1.1 trillion in 2024, now exceeding defense spending for the first time in modern history. None of this works without a willing audience of foreign buyers. The recycling mechanism is simple. Foreign countries earn dollars through trade, use those dollars to buy US Treasury bonds, which finances the American deficit, which maintains dollar demand. It is a closed loop. But what happens when that loop breaks? The Treasury holdings tell the story. China held $1.32 trillion in US Treasuries in 2013. Today, $820 billion, a 38% decline. Japan peaked at $1.23 trillion in 2014. Today, $1.08 trillion, down 12%. Russia held $132 billion in 2013, sold 83% before the total freeze, down to $23 billion today. Saudi Arabia dropped from $164 billion in 2020 to $111 billion in 2024. 32% decline. The pattern is unmistakable. Total foreign treasury holdings peaked at 49% of public debt in 2015. Current level, 30%. $1.3 trillion sold since the 2021 peak. Run the numbers forward. If foreign demand drops another 20% over 5 years, that is $1.5 trillion in lost financing capacity. To attract domestic buyers to replace them, yields must rise. Estimated increase, 1.5 to 2%. Additional annual interest cost on $34 trillion in debt, $225 to $300 billion. This creates a feedback loop. Higher yields mean higher debt service. Higher debt service means larger deficits. Larger deficits mean more bond supply. More supply means higher yields. There is no exit. The policy trap is complete. Scenario A: raise interest rates to defend the dollar and attract foreign buyers. Result: recession, debt spiral, political crisis. Scenario B: keep rates low, let the dollar weaken. Result: inflation, import cost surge, reserve status erosion. There is no scenario C. The Federal Reserve is trapped between defending currency hegemony and managing unsustainable debt. The market has already rendered its verdict. The dollar index peaked at 121 after September 11, 2001. 2023 peak during aggressive Fed rate hikes, 114. The long-term trend is decline despite the strongest monetary tightening since the 1980s, but the real vote comes from central banks. Gold purchases in 2022, 1,136 tons, the highest since 1950. 2023, 1,037 tons. Key buyers: China with 225 tons, Poland with 130, Singapore with 77, all diversifying from dollars. Gold price rose from $1,800 per ounce in January 2023 to $2,050 in December 2024. 14% gain despite rising US interest rates, which should theoretically hurt gold. Central banks are voting with their reserves. The vote is clear: exit dollars, buy hard assets. The crisis accelerates not when foreigners stop buying new treasuries, but when they start selling existing holdings to finance their dollar exit. The data whispers what officials deny. That process has already begun. This is not abstract geopolitics. This is your wallet in the crossfire. The United States imports $3.8 trillion in goods annually. Electronics account for 22%, vehicles 15%, pharmaceuticals 8%. Every 10% decline in the dollar means a 3 to 5% increase in import costs. For the average American household, that translates to $1,500 to $2,500 per year in additional expenses. Direct impact on purchasing power. The inflation transmission is already visible. Between 2022 and 2023, the dollar index fell 8%. Core inflation peaked at 6.6%. If de-dollarization accelerates with a 20% dollar decline over 5 years, economists project sustained inflation of 4 to 6%, even with Federal Reserve tightening. Real wage erosion over a decade, 25 to 30% purchasing power loss. Your salary stays the same, everything else costs more. The retirement crisis multiplies the damage. 60% of American retirement assets sit in the stock market. Corporate earnings for S&P 500 companies derive 40% from international revenue. Dollar decline means foreign revenue translation losses. Earnings compress, stock prices follow. Simultaneously, Treasury holdings in retirement accounts lose value as yields rise and prices fall. The wealth built over decades evaporates from both directions. But from the wreckage, a new understanding emerges. The Sanctions Suicide was not a failure of intelligence, it was a failure of imagination. Washington believed the world had no choice. The data proved otherwise. When survival is at stake, alternatives emerge fast. What replaces dollar hegemony is not chaos, it is choice. Regional payment systems like the Asian Clearing Union, BRICS Pay, Arab Monetary Fund settlements, commodity-backed trade, oil in yuan, gas in rubles, gold-settled contracts, CBDC networks through M-Bridge and Project Dunbar, enabling direct central bank clearing with no dollar intermediation. Bilateral currency swaps totaling $650 billion between non-US countries as of 2024. This is not collapse, this is reconfiguration. For the economically aware, preparation looks specific. Diversify currency exposure through international assets and foreign currency holdings. Allocate 15 to 20% to hard assets like gold, commodities, inflation-protected securities. Reduce dollar-denominated debt by locking long-term fixed rates before currency crisis hits. Develop skill-based income in non-outsourceable services and essential local production. Geographic diversification by holding assets in multiple jurisdictions and currency zones. The United States is not economically doomed, but the free ride is over. Fiscal discipline becomes mandatory, when you cannot finance $2 trillion deficits without willing foreign buyers. Manufacturing reshoring becomes strategic necessity when import dependency equals vulnerability. Energy independence must be maintained, not squandered. Diplomatic restraint becomes pragmatic because every sanction accelerates the dollar's replacement. The dollar earned reserve status through economic strength, trade surpluses, and creditor nation status. Current American profile: trade deficit of $773 billion in 2023, budget deficit of $1.7 trillion, manufacturing at 11% of GDP down from 28% in the 1950s, net international investment position at negative $18 trillion. You cannot maintain reserve currency status while running the world's largest deficits in every category. The sanctions did not just create alternatives. They reveal that dollar hegemony was already living on borrowed time,